Welcome back, guys, to another Zero DTE video, and today Ernie's going to be talking about continuous contracts, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy, guys.
Hey Ernie, could you talk a little bit about continuous contracts and why we had such a variance between the continuous contract and the normal?
Because there's no such thing as a continuous contract.
So I guess I wish I wasn't looking at those all the time then.
They're good for longer term analysis. They're good for when you're not near expiration of a futures contract, because when they get near the futures contract, you got to consider what futures are about. They are a number of overlapping, simultaneously running contracts that have expiration dates. One of those contracts will be considered the front contract or the main contract. It has most of the volume, but there's volume in the others as well. The next month or the next quarter and the following quarter and the following quarter after that. They're all being traded at the same time.
So there's the 1 and the 2, say like NQ1 or NQ2 or ES1.
Well, that would be this quarter and then next quarter.
Okay.
So in equities, the quarters go from March, June, September, and December. And the March contract isn't quite up yet. However, most traders that are trading futures have started to implement what they call a roll. So if they have positions in the March contract and they want to hold on to them, they have to roll them over to the June contract. And at some point, the March contract, even though it is still alive, will no longer be what's considered the front contract or the number one contract. It will be the June contract. Now, everybody has a different idea of when is the proper time to roll. TradingView has their own idea. And what they do is they will switch their continuous contract on their trading chart when they believe is the proper time to roll to the next contract. And all future contracts usually are priced higher than the current contract. So that's why you see that big jump. You know, once we're into this next contract, it's fine to use it as analysis, but you certainly can't trade off of the continuous contract because it's not real, made up.
I just thought it was a convenient way to not keep updating TradingView. That way it's always on the current month, but it's not the same from what you're saying.
As long as you understand what it is and how they've implemented the role, and when you see that big jump that TradingView has switched contracts, it doesn't mean the other contract disappeared. In fact, we're going to still trade the March contract after most people have rolled it.
So explain that, because I would think that March contract would have every expiration in March in it. Is that not the case?
It will expire, I believe, on the 23rd.
But it only went for another week.
Yeah. So we'll be trading the March contract until that is done.
We'll say like Friday, for example. Friday's contract, I was thinking, oh, we're at the beginning of March, so we're not rolling over. To me, I was looking at the wrong one, but I wasn't. Now I'll watch out for it.
Point of view from trading, there's nothing to watch out for. There's only one thing that you can trade.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.